Hello, this is Merrill at Tax Tutor. I am a CPA and I've been helping business owners save money on taxes for over 20 years. I've helped clients save anywhere from $10,000 a year to $1 million a year in taxes. I am very passionate about helping business owners save money on taxes, and that's the topic of today, is 3 ways to save money on taxes using advanced tax strategies. There's what we call like our simple and our basic tax strategies. Those would be things like having an S corporation, using a home office deduction, and things along those lines, vehicle expenses, mileage, and things like that. Those are pretty basic and standard ones. There are some that are more advanced and require either advanced CPA or some other professional to come and help with these things. However, these advanced strategies are what we use to save people $1 million or more in taxes a year, or maybe it's $100,000 or $500,000 or whatever the tax bill is. We can drive taxes sometimes down to 0 depending on the situation using some of these advanced strategies. So there are a lot of advanced strategies out there. We will briefly touch on several of them just to give you some ideas of what type of strategies there are out there, and we'll come back and we'll do actually more detailed videos of all these strategies. I put these strategies into 3 buckets. There's the first bucket is that you use your current assets and resources to save money on taxes. We'll talk about that in a minute. The second bucket is you put money into something, you invest money in something, and you get a deduction or a credit back. In this scenario, there's no material participation needed, and we'll talk about that a little bit. But you basically just put money in and something comes back to you. The third bucket is you put money and or time in to get a deduction or credit. So this is ones that require some kind of a material participation on your part in order to benefit from. So we'll run through those, give some examples of each. So the first one, use your current assets or resources to save money on taxes. So the first example of this one is a cost segregation study. So a cost segregation study is something that works for real estate owners and real estate investors. Instead of taking a building that's normally depreciated over either 27.5 years or 39 years if it's a commercial building, they can break down the components of that building and you can depreciate those components faster and in some cases get a bonus depreciation. So that's an example of taking a current asset, a building that's owned, and getting a tax benefit for it right now. You don't necessarily have to put more money in. You've got to pay like an engineer, like a specialist to do a cost segregation study, but it doesn't require you to go out and buy anything or put any money in, unless you don't own a building. That could be advantage of going and buying a building, and we have other videos that will get into details of that. So that's an example there. Another example of using your current assets and resources is the research and development tax credit. So if you're a business owner and you're doing research and development, it's something that you're already spending money on. Now you can get a research and development tax credit expert to come in, look through your business, see where you're spending money, see where you're doing the research and development, and they can get a credit. It's not something, again, that you really have to go and put more money into other than to pay for the professional to help you with that. But it's a way to get a tax benefit without having to put more money or time into something. Now, the second bucket that we discussed was put money in and get a deduction or a credit back with no material participation needed. Now, this could be like a leveraged asset donation or like a stock donation. That's the easier way to explain it. Like you have invested in stock. So you have stock that you've invested in, you've put money into stock, and now you've held that stock for a year or longer, and now you want to donate it to a charity. When you donate a stock like that to a charity, you get a write-off for the fair market value of that stock. So let's say you paid $100 for a stock. That stock has now appreciated to $1,000. When you donate that stock to charity, you get a $1,000 write-off for that stock. So that's an example. You put money in to buy a stock, let it kind of appreciate, and then get that. There are certain tax credits that work this way as well, where you put money in to buy credits. There's credits that can be transferred from one taxpayer to another. So you would go and buy these tax credits. Maybe for some reason that person, entity cannot use those tax credits and they're willing to sell them. So sometimes, let's say you can buy $100,000 in tax credits for like $60,000 or $70,000. So in that case, yes, you put in $60,000 or $70,000, but you're going to save $100,000. So you're getting $30,000 to $40,000 of savings. So that's an example. You put money in, you get a benefit. Another one along these lines are oil and gas investments. So around the US, there are oil and gas wells. If you invest in those, you get an immediate deduction. There's called depletion that comes along with these. You get this big deduction that comes with that. It saves you money on taxes, and you have an ongoing investment. So that's an example of putting money in, getting a benefit back out without any material participation needed. Like an oil and gas investment, you don't have to go and like drill the wells in order to get that benefit. Oil and gas has a specific exemption in the code that says if it's a working interest in oil and gas, then you get that benefit even though you aren't the one physically doing that work. Now, there are some deductions and credits that you do have to materially participate in, which means that you have to go in and actually put some time into it in addition to putting money. One of these is an equipment leasing type of a business. So you can go and you can buy some equipment and you can lease that out to people. The equipment could cost a lot of money. Let's say that you went and bought $100,000 worth of equipment and you leased it out during the year for $10,000. So you'd have $10,000 of leasing income coming in, $100,000 of expense going out, and so you'd create a loss of $90,000 in that example. This is kind of ignoring depreciation and other sorts of things, assuming that maybe there's bonus or something else along those lines. But, let's say that you bought enough equipment to get a $100,000 depreciation write-off. So that would generate that loss that's in there. Now, generally, losses are passive unless you materially participate in that activity or that business. So an equipment leasing arrangement, you go buy the equipment, you write off the equipment, you recognize less income than the equipment cost during the year because you're going to own that equipment for a while and that equipment's going to bring in money for you over time. But for this year, you've got a tax problem you want to solve. So you go buy that equipment, you recognize a loss. As long as you've materially participated in that business, you can take that loss that is coming through. There's also solar credits that applies to. So you can go and buy solar credits for a company, and this another one that requires material participation, but that will give you a credit that will allow you to offset your taxes. Now, we're talking about two different things here. In some cases, we're talking about deductions. In some cases, we're talking about credits. There is a difference there, and we have a separate video on that. So you can find that video inside of our videos online to learn the differences between a deduction and credit. Generally, credits are better than deductions, but we go through that in detail in that video. Another example where you can put money and time in and get a deduction credit is a short-term rental strategy. When it comes to long-term rentals, those are pretty much all passive regardless of how much you participate, unless you're a real estate professional. And again, we have some more videos on going through that. But for the short-term rental strategy, you have to have some material participation in order to get a deduction for that. And then that short-term strategy, rental strategy, that also involves like a cost segregation and other sorts of things. So just another example there. And like I've said several times, we'll be covering each of these areas that we mentioned in this video in more detail in upcoming videos. So be sure to subscribe so that you can catch those details. And as always, for more tax tips from Tax Tutor, tap the subscribe button for tax updates. And also visit us at taxtutor.com to sign up for our weekly newsletter to help you keep on top of your taxes.